well. This is going to be the review video for your second test. We're going to start with the statement of cash flows, and the company we're going to be doing the statement of cash flows for is Tennessee Sweet Tea. What I provide you on your test is going to be select information necessary to complete the statement of cash flows. In reality, you would have to go and look at all of your financials, your income statement, your balance sheet, etc. before you prepare this. And it requires a lot of searching through the statements and finding necessary information. For the ease of you guys, I've decided just to put it in one simple place. We're going to be using the indirect method, which means we're going to take the change in accounts from one period to the next. In this case, from Tennessee Sweet Tea's 2017 numbers to their 2018 numbers. We're going to need that for their current assets and their current liabilities, and all of those numbers are listed up here conveniently. And we can see right now the number that we're looking for is the solution to our statement of cash flows. It's going to be equal to whatever cash changed by from the last period to this period. So Tennessee Sweet Tea had $20,000 in cash in 2017's end. Now they have $50,000 in cash at 2018's end. So right when we start, we know that the finale, the end line of our statement of cash flows, is going to have to be a net increase in cash of $30,000. To get there, we're going to have to reconcile our net income to our net cash flows. We're going to do that using all the current assets, current liabilities, and a few other select things. As far as investing, financing, non-cash activities, etc., we're going to use all the information provided at the bottom in bullet points, such as the depreciation expense, the sale of equipment, and the associated loss with that sale of equipment, etc., etc. We're going to use all that information as we work our way through. So let's get started with our statement of cash flows. The first thing that we always have on a statement of cash flows is going to be the company's net income. Again, we're going to set up our net income, and then we're going to adjust that net income so we can figure out our change in cash. So let's start with net income, and we're going to find that in the bullets listed on here. So if we go down to our fifth bullet down, we see that Tennessee Sweet Tea had $10,000 in net income. So let's go and fill that in on our statement of cash flows in the right hand column. 10,000. Now we need to adjust, and the first thing that I have always seen in standard formatting, and I advise you guys to do, is your first adjustment should be your depreciation expense. Again, depreciation lowers income, but it's not a cash expense. So as we are adjusting our net income to our net cash flows, we need to add back in that depreciation because it wasn't physically cash that came out. So let's go to our information and see if we can find a depreciation expense. And it's the very first line. We see we have a depreciation expense of $11,000. So we're going to throw that in here. For this section, you're going to want to put all of these numbers in the left hand column because we're going to have a bunch of adjustments that we're going to total up at the end. Second step that I like is to look for any gains or losses. So let's go to our info sheet. And on our info sheet, we see right here in the second bullet down that they sold equipment. And when they sold this equipment, they experienced, let me fix my typo over here because I'm professional like that, experienced a $1,000 loss on the sale. So we can go to our statement of cash flows, throw it in here. We had a loss on sale of equipment. A loss is going to lower your net income, but the reason that losses happen is because at the point when you sold something, it's different from your own valuation of it, and your valuation is dependent on a ton of different factors, namely what method of depreciation you're using, what your estimate for useful life is, things like that. Valuation is not a concrete, there's an absolute right answer. There's tons of different ways of looking at it. I don't know if any of you ever watched Shark Tank. On Shark Tank, when those people come in trying to seek funding for their company, they always ask them what the valuation of the company is, and they come up with wildly different numbers. It's because valuation is based on purely on estimates, on judgments. They're not raw, hard numbers. So you can't have something in your statement of cash flows that is based upon an estimate. Therefore, it is a non-cash expense. And since a loss lowered our net income, what we're going to have to do is we're going to have to add it back in. Our loss was for $1,000. So we go to our statement of cash flows, and we throw that $1,000 back in. Those are our two items that we usually always start our adjustments for. They're going to be the first two adjustments that you have on your test. After that, you get to move on to the two types of accounts which go under the operating section, which are your current assets and your current liabilities. So we go back to our information page here. Let's start with our current assets. We have cash. We're not going to use this line. The purpose of having cash in there is solely so you know you came to the right answer at the end when you get your net increase of $30,000. We're going to take all of our non-cash current assets, and the first one is accounts receivable. During the last period, we had $10,000 in AR. Now we have $15,000 in AR. Well, let's add this in here. We had an increase in accounts receivable. All things equal, if we did the same exact amount of sales and we have more accounts receivable now than we did during the last period, that means that we must be getting paid less in cash. So an increase to a current asset means you must have somehow either spent cash on it or took in less cash. Regardless of that, what it's going to do is it's going to decrease your cash flow. So we had an increase of $5,000, which means that we're going to put our $5,000 in here. But since it is a decrease, let's make that negative. Our increase in accounts receivable decreased our cash flow by $5,000 because we got paid less in cash. So we're going to do the same thing with the next item that we have on our current assets. And our next item is merchandise inventory. It was $10,000 in the prior period. Now it's up to $20,000, which means we had an increase of 10 grand. So let's go to our statement of cash flows. Increase in merchandise inventory. And our increase in merchandise inventory was for $10,000. Well, if we have $10,000 more in inventory, that means that we must have spent more either purchasing it from our suppliers or producing it. So it's a decrease in our cash flow. We've got one more, and it is supplies. So we had $15,000 in supplies at the end of 2017. It is down to $7,000 now, which means that since we have less, we must have spent less on supplies during this period than we did last period. So that is a current asset going down, and when current assets go down, your cash flow goes up. So we're going to have, in this line right here, a decrease in supplies, and our decrease in supplies was for $8,000, and it's going to increase our cash flow by $8,000. So we're through our current assets, and we get to move on to our current liabilities. From our information, we can see that we have two: accounts payable and accrued liabilities. Things like rent payable, utility payable, interest payable, taxes payable, all of those are considered accrued liabilities. They didn't want to make you go through 17 accounts, so I just gave you one account called accrued liabilities. But let's start with accounts payable. We had $20,000 at the end of 2017. It is down to $12,500 now. It's a $7,500 decrease in accounts payable. Accounts payable are things that you owe people. So again, all things equal, if we did the same amount of business and our accounts payable decreased, we must have been paying off more of our debt in cash, and therefore that decrease in our current liability is going to decrease our cash flow. Current liabilities always work the same way as cash flow. So let's add in our decrease in accounts payable, which was for $7,500, and since it is a decrease to cash flow, we're going to put it in negative, and we're going to come up with negative $7,500. Our last one that we have is our accrued liabilities, and as we saw a second ago, and I'll go back, our accrued liabilities decreased. So we have a decrease in accrued liabilities. Well, if we go to our information, we see that our accrued liabilities decreased from $25,000 to $12,500. So that is a $12,500 difference. That's the amount of our decrease. We're going to throw that in here, and we come up with negative $12,500. Since this is the last of our current accounts, our last of our adjustments, if you will, what we're going to do over here is we're going to find the subtotal of it. So we equal sum, open a parenthesis, select the whole entire range of cell B7 to B13 where all of our adjustments are, close the parenthesis, and we hit enter. We come up with a total amount of adjustments of a decrease of $15,000. So our net cash from operating activities is equal to our net income plus our total amount of adjustments. We had from operating activities a decrease in cash of $5,000. We're through the first section. We can move on to the investing section. And the investing section deals pretty much purely with long-term assets, things that you plan on having for more than a year. So we go to our list of bullet points here and we see what we have. Well, right here we had a cash sale of equipment. That is a long-term asset. So we know that the cash sale part, the $21,000, has to go in that section. We already took care of the loss of $1,000 during our adjustments. So our cash sale of equipment, $21,000, is going to go into our investing section. Look through our other things. We have a cash receipt for common stock. Common stock does not go in investing because it's not a long-term asset, nor does dividends. Net income we already took care of. We have a cash receipt from the issuance of bonds payable. Bonds payable, long-term debt. It goes in financing, not investing, so that one's not going to go in there. We have the acquisition of a piece of land by issuing $10,000 of common stock. And you see land and you say that's a long-term asset. But how are we getting that long-term asset? We are getting it by issuing common stock. We're not paying the $10,000 for that piece of land. We're instead giving the company $10,000 in common stock that we're purchasing the land from. Which means that that transaction, no cash changes hands. And that's going to be a non-cash transaction. Since it's non-cash, we don't put it into our regular investing section. We're going to wait on that till we get to the non-cash section. The next one we have is a $6,000 cash payment for the purchase of furniture. Bingo. Furniture is a long-term asset, and we are acquiring it by paying out cash. So we know that cash payment for furniture is going to go into our investing section. And our last bullet, the settlement of a $25,000 mortgage payable by issuing $25,000 of preferred stock. Well, first things first, mortgage payable is a long-term liability. It is not a long-term asset, so it would go into financing section. And even furthermore, we're not paying off that mortgage in cash. We're paying it off by trading something else, in this case preferred stock. So just like this entry up here, the one where we got land for common stock, paying off our mortgage by issuing preferred stock, no cash changes hands. It is also a non-cash transaction. So the only two things that we have that are going to go into the investing section, the only two transactions we had dealing with long-term assets where cash actually changed hands, is our sale of equipment and our purchase of the furniture. So let's go to our statement of cash flows. We're going to call this a cash receipt for sale of equipment. And you can use that exact phrase if you want to. I would be totally fine with you guys just saying equipment sale. That's fine for me as long as you have the gist of what's happening. So when we sold this equipment, we sold it for, one more time, $21,000 right up here. We're going to throw that into our left column on our way to a total. Since we are selling the equipment, we're the ones receiving cash, and our cash flow has to go up. So the sale of any long-term asset is going to increase our cash flows from investing activities. The other thing that we had was the purchase of furniture. So I'm going to call this cash payment for purchase of furniture. Again, if you want to just call it furniture purchase, that's fine with me. We paid $6,000 for that furniture. We paid in cash. Well, if we paid in cash, that means that our cash flows from investing activities has to be going down since we're the ones sending cash out. Since those are our only two transactions, our subtotal is going to simply be equal to our cash receipt from the sale of equipment plus our cash payment for the purchase of furniture. And we get a subtotal of $15,000. Put a space in there. So now we have to find out our net cash provided by operating activities, and that is simply going to be equal to this same subtotal. Now we're on to our cash flows from financing activities. Actually, back this up. You don't need this one right here. We'll instead do this here. I apologize. Now on to our financing activities. We're going to have, to start with, anything that has to deal with long-term liabilities or equity issuance. So as we go through our list, we have a cash receipt from the issuance of common stock. That for sure is going to go on there. It's equity. Payment of cash dividends. That is a cost associated with equity, so that has to go in there. And we have a cash receipt from the issuance of bonds payable. Again, that has to be part of the equation as well. What we're not going to put in there, even though it says stock, are the acquisition of land for common stock and the payment of a mortgage for preferred stock, because those are non-cash transactions. No cash change hands. We're only going to put in the transactions where cash actually, either came into our business or came out of Tennessee Sweet Tea's business. So let's start here. We have the cash receipt for the issuance of common stock. Let's start with that number. And our cash receipt for the issuance of common stock was for, we see right here, $25,000. Since we are the ones issuing the stock and therefore taking in the money, we're going to put that in as a positive number. We had the cash payment of dividends, and the cash payment of dividends was for a total equaling $15,000. Since we're paying the dividends out of the company, it's going to decrease our cash flow from financing activities, so we'll put that in negative. And then the next thing that we have is our cash receipt from the issuance of bonds payable. And the column's not wide enough, so let's just make that bigger. If you ever find this scenario, go up to the top where you get this little black line like that, and you can slide it over till it's the right size. There we go. So we signed a bonds payable, and when we signed that bonds payable, it was $10,000. So we're the ones taking in the cash by selling the bonds. It's going to be positive. And our net cash provided by financing activities is going to be equal to the sum of those three numbers, or $20,000. So now we have our net increase or decrease in cash. What we're going to do here is we're going to have equals, and we're going to make this equal to the three different categories that we have. The first one being operating, so I click on this negative $5,000, plus our investing activities, plus our financing activities. So it's only the three main categories. Don't add in your net income or the subtotal of your adjustments. That's a thing I see commonly, is people just totaling up the second column. It's not. It's just the net cash either used or provided by your three main type of activities. And that will give you your net increase or decrease in cash. And when we enter, we see that our net increase in cash is $30,000, and we're very happy about this, because when we go back to our information, we see that cash did in fact increase from $20,000 to $50,000, which is an increase of 30 grand. Underneath, we have our cash balance on the last date of the prior year. Well, we can just go to our info, click that cell of what it was, which was $20,000, and hit enter, and that'll bring us our cash balance there. And for the end of the current year, again, we can just go to our info, click on the amount of cash that we had, and hit enter, $50,000. So we know that our statement of cash flows is good, because our net increase in cash, according to our statement of cash flows, is absolutely the same increase in cash that we had on our comparative balance sheet. Last step that we have to do is take care of our non-cash activities. And from our information, we already determined there was two. One of them, we acquired land by issuing common stock, and in the second one, we settled a mortgage by issuing preferred stock. Let's go find the sum of those two numbers, and that was going to be for the acquisition of land by issuing common stock, it was for $10,000, and for the mortgage, getting rid of that for preferred stock, it was $25,000. No one has ever properly explained to me why this is, but for the non-cash section, they're typically only going to go into the right-hand column. Again, it's formatting. I'm not going to take off points if you subtotal like the others, but it's not the way it's typically presented. I wish I could give you a better reason. I simply don't know why it became standard to be that way, but that's the way that it is. Which means that our total non-cash activities are $35,000. And with that, we are done with Tennessee Sweet Tea Statement of Cash Flows for the year ended December 31st, 2018. It's half of your test. The other half of your test is your financial statement analysis using vertical analysis, horizontal analysis, common size, and ratio analysis. So in the next video, I'm going to cover all of those. Take care, everyone. For the second part of your test, you're going to have to do a financial statement analysis. And to do a financial statement analysis, you're going to need an income statement, a balance sheet, etc. We're going to be doing it for a company called Bradley Copper Wiring. And the first thing that I'm going to ask you guys to do is do a horizontal analysis of an income statement. So let's do this for Bradley. For Bradley, their net sales revenue went from $78,000 to $84,000. That, as you can see from here, is an increase of $6,000. Well, let's start with our amount column right here. If we take the current year's net sales revenue and last year's net sales revenue, we come up with $6,000 exact. Cost of goods sold was $39,000 in the prior year. It's $38,000 this year. Again, if we do the same formula, equals this year's COGS minus last year's COGS, we see that COGS decreased by $1,000. And we can continue doing this all the way down the line. But this is the joy of using Excel. See, if you click on a cell, so the green line surrounds it, your arrow, which is normally this big fat white cross, if you go to the bottom right corner, it turns into a slimmer black cross. That is called the fill handle. If you grab it and just drag it down all the way through the cells, it's going to copy that same formula you had all the way down. So now we can go and make sure everything worked out okay. Gross profit went from $39,000 to $46,000. That's an increase of $7,000. Selling expenses went from $7,500 to $8,500. It's an increase of $1,000. Everything here looks good. So we have all of our numbers filled in. You can go and delete the spots with the slashes really fast. So now we're ready to figure out what our percent of change was. Again, raw dollars isn't the best way to compare one company to another. We want to do it in terms of percentages. So we're going to start with our percentage here. And our formula is going to be equal to the amount of the increase. Let's put this in parentheses. Amount of the increase divided by the amount we had in the prior year. We'll close that parenthesis and we'll multiply it by 100. And when we do that, we come up with 7.7. We can see that net sales revenue increased by 7.7% from 2017 to 2018. Let's do the same concept here for cost of goods sold. Our cost of goods sold percentage is going to be equal to, in parentheses, the amount of decrease in this case that we had, divided by our cost of goods sold in the prior year, close the parentheses, and multiply by 100. We had a 2.6% decrease in our cost of goods sold, and I rounded all of these numbers off to one decimal. In formatting, it's up here on the top where you can increase or decrease your decimal. It's typical to have percentages expressed to one decimal place. So again, we could go through and we could fill in all those formulas individually, but we're going to cheat. We're going to use the fill handle and we're going to drag it down. And deleting all these weird div zeros, just click on them and hit delete, we get our percent of change. And we can see here that our gross profit increased by 17.9%. Our selling expenses increased by 13.3%. Administrative expenses increased by 4%. Our total operating expenses increased by 8.7%. So on and so forth down the line. So what I'm going to ask you guys to do on the test is give me in a paragraph a brief description of what happened. How can we take information from this to better our business as managers? Well, if I'm looking at this, things are looking good to me. Our sales increased by $6,000, but somehow, despite the fact that we're selling more, our cost of goods sold, our cost to either produce or acquire the wire, actually decreased by $1,000. So we've increased our profitability by either charging more or by selling more units, but somehow decreasing our cost to acquire those units. And even though we had an increase in expenses, that 8.7% increase in operating expenses is less than our 17.9% increase in gross profit. And down at the bottom for our bottom line, we can see right here that we had an increase of 32.7% in net income. Everything is looking good for Bradley Copper Wiring right now. 2018 was a much better year for them than 2017. And with that, we are through our horizontal analysis of the income statement. We can go to a vertical analysis, and I'm going to ask you to do a vertical analysis of the balance sheet. So how do we go about doing this? Well, the percent of total column right here, we want to know what percentage of the base number that is. Again, whatever number we're comparing each individual line item to. And for a balance sheet, the base number is always the balance number, which in this case is our total assets. And if we scroll down, we'll see it's the same number as our total stockholders' equity and liabilities. So, to figure out what percent of our total assets are in the form of cash, we can go and we can take this number and divide it by our total assets. And that tells us that our percentage is 10.1%. Fair enough. For our accounts receivable, we can do the same thing. We can take the amount of accounts receivable we had, divide it by our total assets, and we come up with 17.8%. So 17.8% of our total assets is in the form of accounts receivable, 10.1% is in the form of cash. For inventory, we can do the same thing, and I'm going to change something small up here, but let's start with equals inventory, and we're going to still divide by total assets. We want to use that fancy fill handle thing again, but the problem with that is when you use it, it changes the formula, and it's going to change the second cell that we're dividing by. We don't want that here because we always want to divide by total assets. So what you can do to stop that is make it what they call absolute by pressing the F4 key. When we press F4, you can see the formula that it changed from just B16 to $B, $16. Hit enter. 23.7% of our total assets was in the form of inventory. Now that that cell is absolute and it'll keep dividing by total assets, we can fill handle. And when we fill handle, we come up with all of our different numbers. Very important. Your total assets should always be 100% since that's the base number that you're dividing by, but we get our total breakdown right here of what happened in 2018. We can do the same thing with our accounts payable in the liability section. So we click on the cell, we hit equals, we click accounts payable, we click divided by, and we click total stockholders equity and liabilities, which is that same $236,500. Again, we don't want that second number changing when we use the fill handle, so let's hit F4 to make that cell reference absolute. And when we do, when we hit enter, we come up with 7.6%. 7.6% of our total stockholders equity and liabilities is in the form of accounts payable. Now that we have that, we can fill handle again. And again, these two spots right here that don't have anything next to them, let's just delete those, get them right out of the way. But now we have all of our information. We can see that accounts payable being 7.6% of our total equity and liabilities, accrued liabilities 2.5%, short-term notes payable 1.7%. Our liabilities comprise about 38% of our total equity and liabilities, which by the process of elimination means that about 62% should be in the form of equity. Well, this is great, but we have nothing to compare to, so we have to go through and do the same concept for our 2017 number. So let's click in the first cell. We're going to hit equals the amount of cash we had in 2017 divided by our total assets, which is our base number. We want to make it absolute, so we hit F4, so it changes the $D, $16. We hit enter, and from there we can just fill handle on down. And we're going to come up with the following numbers. Let's do the same thing real fast for our liability and equity section. Equals accounts payable divided by our balance number for that year of 2013, or 213,000, excuse me. We hit F4 to make that absolute. And we come up with 13.1%. Let's fill handle that. And then let's delete these two numbers we don't need. Now we have something to compare to. Let's start up here on the cash line. We can see up here that in the cash line, cash was 15.5% of our assets in the prior year. It's down to 10.1% this year. So our company has become more cash light, which could be a problem if we have an emergency expenditure. We just don't have the free cash on hand to be able to, repair a machine or make a purchase that we need to make. Our accounts receivable has increased greatly from 2017 at 11.5% to 17.8% in the current year. That could be a sign that our company is having issues collecting on our receivables from the people that we are selling to, so it's something to keep an eye on. In inventory, that increased greatly as well, from 18.8% of our assets to 23.7% of our assets. Maybe we're having issues moving inventory, or maybe we simply produce too much inventory for our market demand. There could be several different reasons for it, but the thing to notify is that we had a large spike in the composition of our assets with how much is in the form of inventory and accounts receivable, something we need to look at to fix. None of the other numbers in here are particularly alarming. We had a slight drop off in our property, plant, and equipment, but that's more so contributed to our increase in total assets than it is the raw amount, as we see it only went from 77,000 to 76,000. So talking points in your paragraph, those would be the two numbers that stood out to me. Go down to the liability and equity section. Our accounts payable was 13.1% of our total liability and equity the year before. It's down to 7.6% this year. That's a good thing, not to owe as much money, but it might be also the reason that we are operating so cash light is because we've been paying off more of our payables. Scrolling down through the list, you're looking for a significant jump, and one that is here that I can absolutely see is our increase from 19.7% of our liabilities and equity being in the form of long-term liabilities up to 26.2%. We must have taken out a loan at some point during the period. Not quite sure when that happened, but it must have happened somewhere, so it's something to keep an eye on. We are carrying more long-term debt obligations that could be concerning to our stockholders. Makes a good talking point. None of the other accounts really have that big of a representative change from one period to the next, so I think we are through our vertical analysis of our classified balance sheet for Bradley Copper Wiring, which means we can go to our common size. And a common size is a way to compare our company to something else, and typically that something else is your chief competitor. In this case, Bradley Copper Wiring's chief competitor is Hooter Home Wiring. So we want to compare our numbers to their numbers. Well, Hooters are given, as on your test, the competing company will have their numbers given as well. We need to fill in the numbers, in this case, for Bradley. Well, that's easy enough. Net sales revenue, what percentage was it? If we click in the cell and we hit equals, and we go back to our income statement, we see that net sales revenue was comprised of the amount we had during that year divided by what's always the base number for your income statement, which is your net sales revenue. So I'm basically dividing by the same number again. We're coming up with 84,000. For cost of goods sold, we're going to hit equals. We're going to go back to our income statement. Our cost of goods sold during the current year, which is what we're comparing right here, was 38,000. If we divide that by the base number for net sales revenue, we're going to come up with 84,000. For gross profit, we are going to have our $46,000 divided by our net sales revenue. And you can see you can do this over and over and over again. What happens here if we make this last cell? Oh, not what I wanted. Sorry folks, hold on one sec. If we make this last cell absolute, well, let's click on this. We come up with 54.8%. From here we can use the fill handle because everything's copying down, and look at that, we get all of our percentages. So if we delete out all these zeros that we don't need on the header lines, we have a fair way to compare Bradley's numbers to Hooter's numbers. What's going to happen here? Well, cost of goods sold for our chief competitor is 46%. Ours is 45.2%. It's almost exactly the same, or in fact a little bit better. For operating expenses, our selling expenses are lower, our administrative expenses are lower, and therefore our total operating expenses are lower. And it also means that our operating income is higher. We have a little bit of dividend revenue. They don't have any. Our interest expense is about the same. Our taxes are slightly higher. That is probably because we're more profitable. But in the end, in the long run, we are turning 27.3% of our net sales revenue into income. Our competitor, Hooter, is only turning 19.8% of their sales revenue into income. And the main reason for this difference is we are better than our competitor at controlling costs. Our cost of goods sold is lower, our selling expenses are lower, our administrative expenses are lower. And that's really the big gist of why our company, percentage-wise, is more successful than our competitor, Hooter. So we should be feeling really, really good about ourselves right now. One thing we have left is our ratio analysis, and I'm going to hit that up in the next video, so I will see you there.